You put $1,000 in your bank. They thank you with 0.4% interest. Then they take that exact same 1,000, lend it out at 24%, and pocket the difference. That's not a scam, it's the entire business, and it's completely legal. So let's open up the machine and watch where your dollar actually goes. Here's the thing nobody tells you. A bank isn't a vault. It's a machine. Money flows in one side, gets run through a row of gears, and comes out the other side. Smaller for you, bigger for them. 4 gears do almost all the work. Deposits, money creation, the spread, and fees. Then there are 2 hidden belts driving all 4. A trick of time, and 1 giant lever sitting above the whole thing. We'll get to those. Watch $1 go through it all, and by the end you'll understand how the whole thing prints profit out of thin air. Literally. Drop a coin in. Gear 1. You think your savings are sitting in a drawer with your name on it. They're not. The second your paycheck lands, the bank doesn't store it. It feeds it into the machine. Your money becomes raw material. Fuel. Banks in the US are only required to keep a tiny cushion on hand. Since 2020, the Federal Reserve set that reserve requirement to literally 0%. 0. The rest goes straight back out the door as someone else's loan. So your savings account is really just you handing the bank a tool for almost nothing. Now you're probably thinking, hang on, my money's still in my account. I can see it. And you're right, you can. That's the part that bends your brain. Your dollar is doing 2 jobs at once. On your screen, it's a balance you can spend tomorrow. Out in the world, that same dollar is already a loan funding someone's car. Both are true at the same time, because the bank is betting you won't come asking for all of it on the exact same day as everyone else. That bet is the foundation. Everything else is built on top of it. Think of it like a coat check. You hand over your coat. You get a little ticket. You go watch the show. And while you're sitting there, the attendant quietly rents your coat out to someone on the street. He's betting you won't ask for it back at the exact same moment everyone else does. That bet? That's banking. The whole industry runs on it. He keeps the rental money. You get your coat back at the end, usually. But here's where it gets strange. Gear 2 is the one that breaks people's brains. Banks don't just lend out money that already exists. They make new money. When the bank approves your mortgage, it doesn't go find a saver's cash and hand it to you. It just types the number into your account. Click. That money didn't exist a second ago. The Bank of England, an actual central bank, said it plainly. The majority of money in the modern economy is created by commercial banks making loans. 1 coin goes into the gear. Several come out. Most of the money in your economy wasn't printed by the government. It was typed into existence by a bank the moment someone signed for a loan. Wait, if a bank can just type money into existence, why isn't every bank infinitely rich? Good question. Because typing the number is the easy part. Keeping the bet safe is the hard part. Every loan a bank creates is a promise it has to be able to honor in real cash. Regulators force it to hold a slice of real capital against every loan, its own skin in the game. And here's the discipline. The money it conjured doesn't stay conjured. When you pay the loan back, that typed-up money gets deleted again. Gone. So the bank isn't a money printer with no off switch. It's a machine that creates money on the way out and quietly uncreates it on the way back. The profit isn't the typing. The profit is the rent it charges while the money's out there. And that rent, the steady, boring billions a year money, comes from the next gear, the one that's actually picking your pocket. Not in a dramatic way, in a way so quiet you've never once felt it happen. Let me show you the exact gear. Gear 3, the spread. This is the main engine. It's almost dumb how simple it is. Borrow cheap, lend expensive, keep the gap. The bank pays you maybe 0.4% on your savings. Then it lends that money out as a mortgage at 7%, a car loan at 9%, a credit card balance at 22, 24, sometimes 28%. Picture a pipe. 24% of interest pours in at the top. By the time anything reaches you, the saver, it's down to a trickle, 0.4%. Everything in between stays inside the machine. The industry calls this net interest margin. For a typical U.S. bank, it runs around 3%, and across the whole system, it's the single biggest line of profit. Hundreds of billions of dollars a year, just from sitting in the middle of the pipe. You bring the water, they keep the pressure. Now zoom out for 1 second. Multiply that tiny gap by every checking account, every mortgage, every car loan, every swipe in the country. A fraction of a percent doesn't sound like much, until it's a fraction of trillions. That's how a boring business becomes one of the most profitable on earth. One bank's spread is lunch money. The whole system's spread is a small economy. Now the first hidden belt, the one driving the whole spread underneath. It's a trick of time. Your deposit is short. You can pull it out tomorrow, or this afternoon, or right now. But the loans the bank makes are long. A mortgage is 30 years. So the bank takes money that has to be ready instantly and ties it up in things that won't be paid back for decades. Bankers have a polite name for it: maturity transformation. Short money in, long money out. And the bank keeps the difference for taking on the timing risk. It works beautifully, 99 days out of 100. Because on any normal day, only a few people want their cash, and fresh deposits walk in to replace them. The machine only has to keep enough on hand for the trickle that actually shows up. But notice the assumption hiding in there. Only a few people. On a normal day. Hold that thought, because the 100th day is where this whole thing gets interesting. The 100th day is a bank run.
You cannot leave us here.
Picture it.
Please help us.
A rumor spreads that the bank is in trouble. Everyone reaches for their coat at the exact same moment. But the coats were rented out. The money is locked inside 30-year mortgages. The bank is good for it, eventually. It just can't be good for all of it today. And today is the only deadline that matters when everyone's at the door. This isn't a history lesson. In 2023, a U.S. bank with over $200 billion in assets went down in roughly 2 days. Depositors, many of them tech companies texting each other, tried to yank tens of billions out at once, online, instantly. The bank had the assets. It did not have them in cash that morning. The bet broke. That's the risk humming under every deposit you've ever made. It's also exactly why the next two characters in our story exist: the safety net and the hand on the giant lever. So why doesn't this happen every week? 2 reasons, and they're worth knowing. 1, your deposits are insured. In the U.S., the FDIC backstops accounts up to $250,000 per depositor, per bank. That number is a psychological trick as much as a financial one. If you know your money is safe, you don't rush the door. No rush, no run. 2. When the panic is real, the central bank steps in as the lender of last resort. It floats the cash so a temporary scare doesn't turn into a real collapse. Quietly, that's the deal. Banks run the time trick for profit, and the public, through these backstops, absorbs the worst-case risk. Which raises a fair question. Who's actually steering all of this? Before we answer that, Gear 4. The bonus motor, fees. This is the money the machine takes even when no one's borrowing anything. Overdraft your account by $1? That's a fee. Historically, around $35 to spend money you already had coming. Maintenance fee, ATM fee, wire fee, a late credit card payment, another fee, often in the $30 range, and the one you never see. Every time you swipe your debit or credit card, the bank pulls a slice off the top of the sale. The interchange fee, usually 1 to 3% of everything you buy. The store eats it, then quietly raises prices, so you pay it twice. Picture a row of mesh filters. Your dollar passes through and each one shaves off a sliver. You never feel the cut. But the trays underneath fill up all day, every day. Billions of dollars a year in slivers nobody noticed losing. So follow $1 through the whole machine. You deposit it. Gear 1 turns it into fuel. Gear 2 lets the bank create more on top of it. Money typed into existence. The time belt stretches your short dollar into a long, profitable loan. Gear 3 lends it back to the economy at 20 times the rate it pays you. Gear 4 shaves off a fee on the way past. And the safety net quietly guarantees the whole thing won't tip over while it spins. The dollar that comes out the far side, back to you, worth a little less and a lot more tired. The dollar that stays inside, that's the profit. That's the whole machine. So, who's pulling the lever? 3 hands are on it. The banks themselves, who keep the spread. Their shareholders, who collect it as profit and dividends. And above all of them, the central bank, the Federal Reserve, which sets the one interest rate the whole machine is bolted to. That rate is the master lever. When the Fed raises it, banks raise what they charge borrowers fast and raise what they pay you slowly. The gap widens. Guess who that favors? When the Fed cuts it, the gap narrows, and suddenly banks compete for your deposit again. One hand, one rate, and it tilts the whole table. And here's the honest part, the stuff even we can't see. We know the spread exists and roughly how big it is. We do not know the exact margin your specific bank makes on you. That's locked inside their books. We can read the totals the banks report to the FDIC. We can't read the deals they cut behind closed doors, or which depositor will lose their nerve first. So when anyone hands you a precise number, ask where it came from. We'd rather show you the gear than fake the reading on the dial. Receipts are on screen. Federal Reserve, for the reserve requirement and rate data. The FDIC, for deposit insurance and what U.S. banks report they earn. The Bank of England, on how money is created. Public reporting, for the 2023 collapse. Check them yourself. That's the whole point. This is how the machine works, not what to do with your money. That part's your call. Next, we crack open a single credit card swipe. 4 companies take a cut before the store sees a cent. Subscribe, and we'll keep pulling these things apart, one gear at a time.